there is a lot candlestick patterns that are taught in all these cheat sheets, and they have all these obscure names and uh, lead people to just simply look at patterns without once again understanding anything else. And in my opinion, that's not a way to do things. But on the other hand, there are candlestick patterns which can help you determining a bias for the upcoming days and weeks. So the candlestick patterns that are only viable on a higher time frames. What I mean by that is I personally only look at a daily and weekly and also monthly, if you want, charts for them. Okay, anytime you will go below that, you will just see too many of them, and they will have no significance whatsoever. Another thing is that you can face issues based on your trading styles and expectations. If you will have a bias based on a weekly candle, and you are trading a 5-minute chart, for example, what can easily happen, that market will just do nothing for 2 weeks, and then the whole anticipated, kind of a sell-off, if you are bearish, will happen. This doesn't mean that the candlestick pattern didn't work. It just means that it takes time. It's a high time frame bias, so it's one of those things, and it's the kind of a overall theme when it comes to trading, is that you cannot be doing these things really blindly. It's not anything I cover here is not a 100% systematic way of trading. You need to think about decisions you are about to make. So as these patterns are great and they are very simple to spot, you need to put a little bit of a thinking into that. So for example, if you are closing week on a bearish weekly candle with a bias, going all in short on Monday open is not the best way to do things, so yeah, just a little bit of a disclaimer when it comes to these things. They are not 100% systematic. Also, you need to be able to spot when they are not about to work out, because you cannot get stuck in a position for a long time playing something that is all gone. Okay, these things don't have 100% strike rate, same as anything, which obviously if you are doing day trading or swing trading, you will get taken out from a trade in a couple of minutes or couple of hours. But if you have a weekly bias, you can get stuck in a trade for 2 weeks, being completely kind of ignorant towards the fact that this is just not going to happen, or it's just something not worth pursuing. So mark these, start observing these, how market is behaving around them, but don't take these for too granted. Okay, the first one is a engulf. The bullish engulf, or the engulfing candle, has to take it's basically the candle which trades a below the low and close above the high in a bullish example, and in bearish example it trades above the high and has to close below the low. Okay, the close here on the daily or weekly time frames is going to be important. Okay, this is a clean sign of one side trying to do something, this wick to the downside for this bullish case, but buyers clearly kind of overcome them and just closed on the complete opposite of the candle. Same for the selling. You want to see them funnily enough as more of a reversal candles. Okay, when market is going up and you will get a bullish engulfing in a trend, it's not as great as when market is going up and you will get bearish engulfing in an uptrend. This can be clean signal of potential reversal. Same for the opposite side. So here we have a daily chart, and you can see what I've been talking about. Okay, this is I think it's a Luna chart again actually, but on a daily you can see market is going clearly up, then it will, all of a sudden at the top print this huge bearish engulfing candle, which will cause the reversal of the whole trend. Then market is going down, it will all of a sudden print this bullish engulfing candle at the bottom of the trend, and market will make, a little bit of a reversal from there. Okay, so these things, I know a lot of people are trying to kind of use them as trend continuations. Buyers are still clearly in control or sellers in control, but when you see them in the opposite directions, that are actually better. The failed swing is once again this kind of a failure of at the level, and like I said, it can look as this SFP candle, which has this long wick, the doji candle basically, or it can be this high volume bar, which is basically the same thing. This happens over the 2 days, this is the 1 day thing. Okay, so for this example I chose the simple one. This is more kind of a rare to see, so we might take a look at this a little bit later on, but this clean A wick is a good signal by itself. This is a weekly chart on a Bitcoin, and you can see how on a weekly candles this market actually loves to reverse on these failures. Okay, you have a one here, you have the one here which caused this move up, you have the one here, you have a one here, and yeah, these are, like I said, you have a key swing low on a daily, weekly chart. Market trades below it, closes above. Key weekly swing low, market trades below it, close above. Swing high, market trade above it, close below. Key swing high, market trades above it, close below. And once again, this is one of those things that I mentioned. It happens here. This is summer of 2021. 1, 2, 3, 4 weeks where market did basically nothing. Does it mean that this candle is invalidated? It does not. It would be invalidated only if we would breach this low again. Okay, which didn't essentially happen, but this is the problem with your expectations. Okay, so something you really need to kind of pay attention to, and you can see that you have a bullish engulfing candle after this kind of a slow bleed to the downside. Then you make a bullish engulfing candle, market will just rally. This week only happened on Binance. This is some weird thing there. Okay, so this is the failure candle, failed swing, the SFP, whatever you want to call it. The inside day is more of a complex candle. This is mostly for people who are focusing on day trading. Even intra-week trading can be kind of valid if you will use it as a inside week instead of inside day. It is a candle that basically does not breach the prior candle. Simple as that. It tells us that the volatility got compressed, which low compression in volatility usually leads to the increase in volatility later on. Okay, so how you are trading these, you are marking out a high and a low of a inside a high and inside a low. The conventional wisdom is teaching people that these are breakout candles, that once one side of inside A is broken, you are trading the continuation. What often happens is that one side of the inside A is broken. Okay, this is the inside A low, inside A high. One side is broken, market really cannot continue here, use this low as resistance. But once we kind of get back inside this inside A range, you will make a run to the opposite side to take the inside A high. So for me, these are more of a levels rather than set stone that market closed here, I'm going short, expecting this to roll over. Okay, so inside A's, failed swings are usually the kind of a reversal candles, and also the engulfings are for me more of a reversal candles. Okay, but when it comes to engulfing, you want to be playing the direction when it's you have a bullish engulfing, you are looking for longs, you have a failed swing, you are looking for any sort of reversal, and you have a inside A, you are looking basically, you just adding new set of levels, either playing continuation of the inside A, or once that fails you can play the rotation to the upside. Okay, so that's it.